just to introduce myself briefly, I'm Bevan Miller. I'm the Chief Financial Officer here at NZX. I joined in December 2012, so in one of the dark blue boxes on Tim's very involved structure chart. And look, I've come into the company at an exciting time. Both, obviously, we've been in a good space in the capital markets in 2013, but as you're getting a flavour of, lots and lots to do. Going to talk very briefly about the market operations piece. In fact, just one slide on that, and that's not, the brevity and placement of that is not to denigrate its importance to the company. This is about 20% of our revenues, but more just to reflect the fact that this is a business that's in a slightly different space to the other businesses that we've been talking about. These are, so there's two parts at the moment to our market operations. One, the contracts that we run for the Electricity Authority, supporting the New Zealand electricity markets. There are 4 large contracts there. And then the second part is the Fonterra shareholders market, which was very successfully launched in 2012, and we've talked a bit about through this. Those are large, reasonably complicated annuity contracts, quite high value. For this business, the focus is really about execution for the next 2 to 3 years. For the EA contracts, those were renewed in 2012 and currently run through to 2016. The authority has the option of renewing those further, or they may well go to tender on those. So our focus is on continuing to operate those well and positioning ourselves as best we are able for what may transpire in the 15-16 time frame. And those are contracts that still sit very much within the core expertise of NZX as a market operator and a technology developer. Fonterra, again, another long-term market, and just a good example of how we can leverage capabilities that we already have into other spaces. But these things have some pretty long lead times, long development cycles, and there's kind of nothing coming on the immediately foreseeable future. So these are, as I say, longer-term views. Turning then to a subject that's dear to a CFO's heart and probably dear to a number of investors' hearts, the cost aspect of life. So in the exchange business, we talk about having a reasonably fixed cost base, and you'll look at this slide and say, don't see much fixing. What this reflects is, as we've gone through that transition out of the history that Tim described, there's a bit of an investment cycle that we've been going through. And I think, if you look at our largest cost is personnel. 2010, we had a headcount of about 155 people in the business. That fell through 10, 11, and costs fell commensurately. But I think everybody in the industry recognised that there was some investment to be made to rebuild capability and perhaps engage a little bit better with our market. So that was very much the flavour of 2012, was rebuilding capability, and also in there was the gearing up for the Fonterra shareholders market. I think there was an extra 10 or 11 positions that were created through that exercise. So we saw staff numbers get up into the 170s again, which was a much better place for us to be, given the market that we're serving and the opportunities that we're trying to deliver on. Yes, that has some cost implications. The other thing that sort of exacerbated it from a P&L sense was that the kind of projects we were doing in the company changed somewhat. There were less of the big development projects like the build out of the clearinghouse, and so the amount of that labour that was going to the balance sheet decreased, so the net personnel cost number increased as well. But in cash terms, the growth rate wasn't quite as significant. 2013, we've seen that change a little. There's still some cost growth there on the personnel side. That's been more about filling in the last gaps and targeting those areas that are aligned to the opportunities that we've talked about. So, adding to the markets team and getting the people out there to go and grow the IPO pipeline. Building out NZX.com and its capabilities. We've hired a digital editor to do that. So that's smaller tactical investments. So your obvious question is 2014. What's that profile look like? We see that growth tapering off. It won't be sort of flat in 14 because you've sort of got the lapping effect as a full year of additional hires comes in, and there were some compensation adjustments as well towards the end of 13 to align to market. But we kind of feel we're at the right level now of capability and resource within the organisation. The other area you saw some of that cost growth was in the IT line, and again that reflects an investment cycle, a slightly different investment cycle. But as we've built out new systems, implemented the clearinghouse system that came on stream late 2010, there's obviously a support and maintenance cost that comes with this. Implemented the NZX Extreme trading system in 2012, and again that upped the cost with that. And there was also some remediation efforts to do to get our systems into the places where we wanted them to be that drove that cost increase through 12-13. Again, we see that tailing off in 2014. And we're pretty focused on delivering within the envelope of where we are now. Just kind of get back to that level we feel that the business should deliver of growing operating leverage as new revenues come on stream. Sitting in there, there's a couple of items that create a little bit of noise, particularly in the professional fees line. As you'll no doubt be well aware, we've been engaged for some time in a lengthy litigation process that dates back to the acquisition of Clear. We're at the end of discovery on that, and that, as the slide calls out, that drove nearly $1 million of costs in 2013. We're not looking at a court date before 2015, unfortunately, so there will be a period of ongoing costs there, but the good news is that will eventually drop out of the base, and we sincerely hope not to replicate that. Also, just in the fund expenses, there was a little bit of remediation cost in this year that drove the increase, but that won't be replicated in 14, although if we're doing our job well, we will see some growth in that line just based off growth in the underlying businesses themselves and funds under management. So costs, the key takeaway there is we are coming to the end of a 2 to 3 year investment cycle, and aiming to manage to a much more constrained cost envelope in 14-15. The other side to that, in terms of money spent, is CapEx. A reasonably instructive graph here that looks at our CapEx spend, going back to 2006. When you recall, we were purely an exchange business then. There's a few takeaways from that. I guess the first is that 2009 was a pretty exceptional year, and kind of distorts the graph. There's the red and green bar are the results of acquisition, so that, as I say, kind of distorts the figures a bit. Red being the software that was acquired when we bought MCO. A certain portion of the purchase price was allocated to software. Likewise, green was the purchase of the Clear business, and again, which was mostly a software acquisition. So those are unusuals and don't repeat. The next sort of point to take out of that is that, sort of in a BAU sense, there's kind of for a normal year, a $2 to $3 million spend as our recurring capital reinvestment here. So the dark blue piece is physical assets, which is largely IT infrastructure and some property assets where we're doing office fit out or furniture and such. We don't spend a lot on that, and then the slightly larger driver in yellow is software assets, and again that's just sort of our BAU investment. So in a normal year, in the last 2013 was pretty normal. We sat around the 3 million level. The other thing that drives our CapEx profile and creates some lumpiness are the major software builds. In orange there was the build out of the clearinghouse that went for a number of years and became quite a large project. And then in purple in 2012 was the replacement of the trading system. So those are infrequent spends. We will need to do an upgrade of the clearing system at some stage. Current feel is that might be a 2015-16 kind of item. Quantum, look, we haven't scoped anything, so it's hard to say, but at the moment, best guess would be that's a kind of a $2 to $3 million type project max. Likewise, again, there'll be a life cycle upgrade to NASDAQ, the Extreme system. Again, currently that's sheeted in for 2019, so some way off. That date will no doubt move around as we get closer towards it. So, there's some periodic reinvestment but again, those are within a more contained envelope than, say, that some of those peaks would suggest. Clear doesn't have the same sort of reinvestment profile. It's just an ongoing incremental build to the website. So it's not like in 5 years' time there's going to be another multi-million-dollar lick of capex against that. So we see a reasonably manageable capital portfolio going forward with our existing businesses. Won't bore you with all the words on that slide as it kind of repeats what was in our investor pack, but just to touch briefly again on distribution profile, because it does follow from the last couple of slides. We moved this year to a free cash flow based distribution. I know that makes it a little bit more challenging for the analysts in the room to predict and say a earnings based multiple. Why we've done that is, one, to emphasise that actually we manage the business for free cash flow, but two, to reflect that as you saw from the last graph, our historical investment, which kind of drives our depreciation expense, doesn't necessarily reflect what our cash flows are going to look like in future. And so we thought it made more sense to align the distributions to shareholders more with the cash that the business is actually generating. So we're targeting a payout ratio of around 80%, but also as we transition and to give an early signal, we plan a fixed distribution of total 6 cents for this year, and reverting to a more normal 6 monthly distribution.